What you are witnessing right now in the crypto markets is not just another dip, not just another routine correction. It is a shockwave moving through a system that has been stretched to its limits. Prices that only months ago seemed unstoppable are suddenly breaking down, and the speed of this shift is what should truly get your attention. Bitcoin, which had climbed into historic territory and fueled expectations of a continued rally, is now moving through violent volatility, and the sell-off unfolding in early 2026 is being described by many institutional desks as one of the most technically extreme deviations from long-term averages in more than a decade. When an asset trades multiple standard deviations below its long-term trend, that is not noise. That is stress in the system. But here is where the signals begin to fracture, and this is what makes the moment so difficult to interpret. On one side, you see prices falling, lenders suspending withdrawals, leverage positions being unwound, and headlines that feel almost identical to those that appeared during previous market panics. On the other side, you see something very different beneath the surface. Trading volumes remain massive. Institutional flows into certain exchange-traded products have not collapsed. Long-term holders are not exiting at the same rate we saw in earlier crises. These are conflicting signals, and when markets send conflicting signals, it usually means something deeper is unfolding than the headlines are telling you. I have watched markets long enough to recognize this pattern. It appears again and again in financial history. In 1998, during the long-term capital management crisis, markets appeared calm until leverage began to unwind. In 2008, the first signals were not bank failures, but funding stress and liquidity withdrawal. In March 2020, the earliest warning was not a collapse in earnings, but a scramble for dollar liquidity across the globe. What we are seeing now has that same signature. Not panic selling in the traditional sense, but orderly deleveraging, positions being unwound in a controlled but relentless way. And that brings us to the real causes, the forces that are actually driving this movement. The first is liquidity. Global liquidity conditions have tightened compared to the explosive expansion that fueled the previous rallies. Central banks are still navigating the aftermath of the most aggressive monetary tightening cycle in decades. And even when rates stabilize, the lag effects of that tightening continue to drain speculative excess from the system. Crypto, by its very nature, is highly sensitive to liquidity. It behaves like a high beta instrument tied to the availability of capital, and when liquidity contracts, even slightly, the impact on price can be disproportionate. The second force is leverage. During the last rally, leverage built up across derivatives markets, structured products, and lending platforms. Leverage is like oxygen for a rally, but it is also fuel for a fire when sentiment turns. When prices begin to decline, leverage positions must be unwound, and that unwinding creates mechanical selling pressure, regardless of long-term conviction. This is not emotional selling. It is mathematical selling, and mathematical selling can be far more powerful than fear. Now, as you look around the global landscape, you begin to see confirmation of these pressures beyond crypto itself. Equity markets are experiencing increased volatility. Bond yields are reacting sharply to every new inflation and growth signal. Commodity markets are swinging between fears of recession and fears of supply shocks. These are not isolated events. They are interconnected movements within a single global financial system that is still adjusting to a new era of higher capital costs and geopolitical fragmentation. And yet, here's the contradiction that makes this moment so fascinating. Even as prices fall, the structural story that supported Bitcoin's rise has not disappeared. The supply remains capped. The circulating supply is approaching its maximum. Institutional participation, once a distant dream, is now a measurable reality. The infrastructure surrounding digital assets, custody, derivatives, regulated funds, continues to expand. In other words, the foundation appears stronger than it was in previous cycles, even while the price is falling. That is not the typical profile of a collapsing asset. So, What does this mean? It means we are not looking at a simple narrative. We are not looking at a story where everything is bullish or everything is bearish. We are looking at a transitional phase, a moment when the market is attempting to reprice risk in a world that has fundamentally changed. Capital is no longer free. Geopolitical uncertainty is no longer a temporary shock, but a permanent feature. And investors, from retail traders to sovereign funds, are still learning how digital assets fit into this new financial architecture. Standing here, looking at the data, watching the flows, and listening to the signals coming from different corners of the market, one conclusion becomes clear. The sell-off itself is real, the volatility is real, and the stress in the system is real. But the story is far from over. What you are witnessing is not the end of a cycle. It is the middle of a transformation, and the forces shaping this transformation are much larger than any single asset, any single market, or any single headline. Now, I want you to shift your attention with me because while everyone is staring at the crypto charts, something equally important is happening in another market, one that has existed for thousands of years, one that has survived empires, wars, currency collapses, and financial experiments of every kind. I am talking about gold, and right now the signals coming from the gold market are deeply contradictory, and that contradiction is what you need to understand. You see, in moments like this, people instinctively expect gold to surge. That is the narrative most of us have learned. Crisis equals gold rising. Liquidity panic equals gold rising. Currency fear equals gold rising. But markets are never that simple. Sometimes gold rises late. Sometimes it falls first. Sometimes it moves in ways that confuse even experienced observers. And that is exactly what we are seeing now. There are periods in history when gold did not behave as the textbooks predicted. In 2008, during the initial phase of the financial crisis, gold fell sharply alongside equities, not because its role as a safe haven had disappeared, but because investors needed liquidity. They sold what they could sell, not what they wanted to sell. The same thing happened in March 2020, when even U.S. Treasury markets experienced stress and gold briefly dropped as funds scrambled to raise cash. When liquidity tightens, correlations break down. Safe havens do not always act like safe havens in the first phase of a shock. And this is where I want you to pay close attention. The global financial system today is carrying an enormous amount of hidden stress. Debt levels, both sovereign and corporate, are at historic highs. Real interest rates, while fluctuating, remain far above the levels that prevailed during the decade of ultra-easy money. Governments are running deficits that would have been unimaginable 20 years ago, and central banks are walking a narrow path between inflation risks and growth risks. In such an environment, gold is not just a commodity. It becomes a mirror reflecting confidence in monetary systems themselves. But here is the tension that defines this moment. On one side, central banks around the world continue to accumulate gold at one of the fastest paces in modern history. This is not speculation. This is reserve management. Nations that once relied almost entirely on dollar-denominated assets are gradually diversifying, quietly but steadily. That is a structural force, and structural forces move slowly but powerfully. They do not show up in daily headlines, but they shape long-term trends. On the other side, short-term pressures are pulling in the opposite direction. Stronger currencies in certain regions, rising real yields at times, and shifts in global capital flows can create downward pressure on gold prices, at least temporarily. When yields on safe government bonds rise, gold faces competition because gold does not produce income. That is a simple economic reality, and it has influenced gold cycles for decades. This is why the idea of a sudden gold crash appears in some forecasts, not because gold has lost its relevance, but because markets move in cycles of liquidity and tightening, optimism and stress. When speculative positioning builds up, corrections can be sharp. When expectations become one-sided, even a small change in macro conditions can trigger large price movements. That is not weakness. That is the nature of financial markets. I want you to understand something important here. Gold is not driven by a single factor. It is influenced by real interest rates, currency movements, central bank policy, geopolitical risk, and investor psychology all at once. That is why it often confuses people. They look for a simple cause, but there is rarely a single cause. Markets are ecosystems, not machines. And when you look at the world right now, you see forces pulling in opposite directions. Geopolitical tensions remain elevated. Trade disputes are reshaping supply chains. Energy markets remain sensitive to regional conflicts. At the same time, technological optimism, artificial intelligence investment, and pockets of economic resilience are keeping risk appetite alive in certain sectors. This is not a world moving in one direction. This is a world fragmenting into multiple economic realities at once. That fragmentation creates volatility, and volatility creates moments when assets behave in ways that seem irrational at first glance. Gold may weaken even while long-term demand strengthens. Prices may fluctuate even while reserves are quietly increasing. Headlines may shout one narrative while underlying data whispers another. From where I stand after years of watching these cycles unfold, the most important thing you can recognize is this. Gold is not simply rising or falling. It is being pulled between two powerful forces, the short-term gravity of liquidity conditions and the long-term gravity of monetary uncertainty. And when two forces of that magnitude collide, markets do not move in straight lines. They move in waves, in shocks, in sudden reversals that leave observers searching for explanations after the fact. So, as you listen to the noise, as you hear predictions of crashes or rallies, remember what history teaches us. Gold has outlived every monetary regime that tried to replace it. It has fallen many times, sometimes sharply, but each fall occurred within a larger story shaped by the evolution of the global financial system itself. And that larger story is still unfolding right now, in real time, in front of all of us. Right now, I need you to step back with me and look beyond individual charts, beyond Bitcoin, beyond gold, beyond the daily headlines flashing across financial media. Because what is unfolding is not just a movement in one market or another. What you are witnessing is the effect of a much larger game being played at the level of global liquidity, interest rates, and capital flows. The invisible forces that determine the direction of every major asset class, whether people realize it or not. For more than a decade after the global financial crisis, the world lived in an environment of extraordinary monetary expansion. Central banks lowered interest rates to near zero, in some cases below zero, and injected trillions of dollars into the financial system through quantitative easing. That period created a generation of investors who became accustomed to abundant liquidity. Capital was cheap, leverage was easy, and risk assets, from technology stocks to real estate to cryptocurrencies, thrived in that environment. But history shows us that monetary regimes never last forever. The inflation shock that began earlier in the decade forced central banks to reverse course and tighten policy at a pace not seen since the early 1980s. When interest rates rise rapidly, the effects are not immediate. They move through the system slowly, like a tide pulling water away from the shore. Liquidity drains, credit conditions tighten, and assets that once depended on easy money begin to feel the pressure, months or even years later. That delayed effect is one of the least understood dynamics in macroeconomics, yet it is one of the most powerful. And this is the battlefield on which gold and crypto now move. Both are sensitive to liquidity, but in different ways. Bitcoin reacts quickly, often violently, because it sits at the frontier of speculative capital. Gold reacts more slowly, influenced not only by liquidity, but by real interest rates, currency trends, and central bank behavior. But both are ultimately tied to the same underlying force, the global cost of capital. I want you to consider what happens when governments around the world carry debt levels that are historically unprecedented, while interest rates remain structurally higher than they were a decade ago. Servicing that debt becomes more expensive. Fiscal deficits widen. Governments must issue more bonds, and markets must absorb that supply. This creates pressure across the entire financial system, influencing everything from currency valuations to equity risk premiums. These are not abstract concepts. They are the mechanics that shape the real world you and I live in. At the same time, geopolitical tensions are no longer isolated events, but a persistent background condition. Trade disputes, regional conflicts, and the restructuring of global supply chains are reshaping the flow of capital and goods. When supply chains fragment, efficiency declines, costs rise, and inflationary pressures become more persistent. Central banks then face a dilemma: tighten policy to control inflation and risk slowing growth, or loosen policy and risk currency instability. This tension creates volatility across all markets, including commodities and digital assets. And yet, even within this environment of tightening and uncertainty, there are pockets of resilience that complicate the picture. Certain sectors of the economy continue to grow. Technological investment remains strong. Labor markets in many advanced economies have proven more resilient than expected. These conflicting signals make it extremely difficult to interpret the direction of markets in the short term. The world is no longer synchronized. It is moving in fragments, with different regions and sectors experiencing different economic realities at the same time. This fragmentation is one of the defining features of the current era. In previous decades, global growth cycles tended to move together. Today, you can see one region tightening policy while another is easing, one currency strengthening while another weakens, one market rallying while another falls. Capital moves rapidly across borders, seeking opportunity, reacting to risk, and amplifying volatility wherever it flows. If you look back at history, you will find parallels to this kind of environment. The late 1960s and early 1970s were marked by rising inflation, geopolitical tensions, and the eventual breakdown of the Bretton Woods system. The late 1990s saw financial crises ripple from Asia to Russia to emerging markets, each event reshaping global liquidity in unexpected ways. The lesson from those periods is clear. When the monetary order is in transition, markets become unstable, correlations break down, and sudden shifts become more frequent. And that is exactly where we are now. The global financial system is adjusting to a new reality in which capital is no longer free, inflation risks remain present, and geopolitical uncertainty has become structural rather than temporary. In such an environment, volatility is not an anomaly. It is the norm. Sharp moves in crypto, sudden corrections in commodities, and abrupt changes in bond yields are not isolated events. They are symptoms of a deeper transformation. So when you see Bitcoin falling while gold hesitates, or equities rising while bonds sell off, do not assume the markets are behaving irrationally. What you are seeing is the result of multiple forces interacting at once: liquidity cycles, fiscal pressures, geopolitical shifts, and the psychology of investors trying to navigate a world that no longer follows the patterns of the past decade. Standing here, watching these movements unfold in real time, I can tell you with certainty that the most important story is not the price of any single asset. The real story is the transition of the global financial system itself, a slow, uneven, and often chaotic shift from one monetary era to another. And until that transition stabilizes, the waves you are seeing in crypto, in gold, and across the entire market landscape are likely to continue, rising and falling with a force that reminds us just how interconnected this system truly is. Now we arrive at the question that everyone is asking, whether they admit it or not: what happens next? I can see the tension in the markets. I can see the confusion in the headlines. And I can feel the urgency in the way people are searching for certainty. But markets rarely give certainty. What they give are scenarios, probabilities, and signals. And right now, those signals are flashing in multiple directions at once. You have to understand something very clearly. Financial systems do not move in straight lines. They move in cycles, in waves, in phases that often look chaotic while they are unfolding. And at moments like this, the future does not exist as a single path. It exists as several possible paths, each shaped by the same underlying forces: liquidity, interest rates, geopolitical risk, and investor psychology. One scenario, and you must listen carefully here, is the stabilization scenario. In this path, liquidity conditions gradually improve, not because central banks suddenly reverse course, but because markets adapt. Debt is refinanced, leverage is reduced, and volatility begins to compress. We have seen this before. After the panic of 1998, markets stabilized and entered a powerful expansion phase. After the shock of March 2020, liquidity injections restored confidence and risk assets surged. In this kind of environment, assets that have been heavily sold often recover, not instantly, not smoothly, but steadily as confidence returns to the system. But there is another scenario, and this one cannot be ignored. It is the prolonged volatility scenario. In this path, inflation remains stubborn, central banks remain cautious, and real interest rates stay elevated longer than markets expect. Liquidity does not collapse, but it does not expand either. Instead, the system enters a grinding phase of uncertainty, where rallies fade, corrections repeat, and investors struggle to find direction. History offers many examples of this kind of environment. The 1970s were marked not by a single crash, but by years of instability, alternating between fear and relief, between tightening and easing, between optimism and disappointment. And then there is the scenario that few people want to discuss openly, but experienced observers always keep in mind, the systemic shock scenario. This is not a prediction, but it is a possibility that exists in any highly leveraged global system. A sudden credit event, a sovereign debt crisis, or a geopolitical escalation could trigger a rapid repricing across markets. When systems are tightly interconnected, stress can spread quickly, moving from one asset class to another, from one region to another, faster than most people expect. We have seen this in 2008, when a crisis in mortgage-backed securities cascaded into a global financial meltdown. We saw it in 2011 during the European sovereign debt crisis, and again in 2020 when a health crisis became a financial one within weeks. But here is the critical point I want you to understand, and I want you to hear this clearly. None of these scenarios exist in isolation. Reality often unfolds as a combination of them. Periods of stabilization interrupted by shocks, moments of optimism followed by renewed tightening, markets moving forward, then backward, then forward again, not in a straight line, but in a jagged, unpredictable pattern. That is how transitions in the global financial system actually occur. As I stand here and look at the data, what matters most is not guessing which scenario will happen tomorrow. What matters is recognizing the signals that tell you which path the system is beginning to follow. Watch liquidity conditions. Watch real interest rates, not just nominal ones. Watch credit spreads, because stress in credit markets often appears before stress in equities or commodities. Watch capital flows, because money always moves before narratives change. These are the indicators that professionals monitor, not the daily noise of headlines or the emotional swings of social media. At the same time, never underestimate the psychological dimension of markets. Fear and optimism are powerful forces. Narratives can amplify trends, accelerate moves, and sometimes push prices far beyond what fundamentals alone would justify. Every major cycle in financial history, from the South Sea bubble to the dot-com boom to the housing bubble, was driven not only by economic forces, but by human belief. And belief, once it begins to shift, can change markets with astonishing speed. So where does that leave us now at this precise moment? It leaves us in a period of transition, a period where the old assumptions about money, liquidity, and global stability are being tested in real time. It leaves us in a world where volatility is not an exception but a feature, where sudden moves are not anomalies but signals, where the next chapter of the financial system is being written day by day, trade by trade, decision by decision. And if there is one final thought I want to leave you with, It is this. Markets are not just numbers on a screen. They are reflections of the collective decisions of governments, institutions, and millions of individuals reacting to uncertainty. They are living systems, constantly adapting, constantly evolving. And right now you are watching one of those moments when the system is searching for a new equilibrium, a new balance, a new direction. The outcome is not yet written. The forces are still in motion. And the next moves, wherever they lead, will shape not only the future of crypto, not only the future of gold, but the future of the global financial landscape itself.